Welcome to the Monday Money Tip podcast presented by Fully Funded Life. My name is Joe Sangle, and we are excited to help you take your finances to the next level on this Monday. I'm joined, as always, by my co-host, Megan Hibbard. Are you fired up today?
Fired up. It's sunny here. The kids are back in school. We're trying to get routine,
We're going to talk about a hot topic today. And the hot topic is interest rates. And Megan, the world wants to know your thoughts. In fact, I've had a million trillion emails this week saying we need to hear from Megan. Megan, are rates going to stay the same or go down?
I think pre-episode, this is what I think. I think they will slowly go down, but they will still stay higher than they were.
Okay.
That's my opinion.
There we go. That's Megan's thoughts. Well, there are loud voices. They want interest rates to be reduced. We all have heard President Trump saying, I want them lowered. And the Federal Reserve Chairman, Jay Powell, and the Federal Open Market Committee, which sets interest rates for the federal funds overnight rate, well, they haven't done so far. But now that you've spoken, Megan, maybe they'll move, because it's the Megan Index. Okay. Now we're going to discuss some theories and some data about this in a couple of minutes. But first, let's think about who just might be interested in what happens to interest rates. Why does this matter? So, Megan, list some people who just might be interested in what interest rates are.
Yeah. So there's one category. So borrowers. So maybe you're in the market to purchase a house.
I can't tell you the number of people that are looking to buy a house who've delayed, Megan, waiting for lower rates.
Yeah, I've heard of it. Yeah. I've heard them too. So maybe those that purchased a house at a higher interest rate and are hoping that interest rates decline so that they can maybe refinance, get a lower rate.
I will also say there's a huge quantity of people who've done that. And it's tight right now, and they're hoping against hope that it lowers so they can get some margin. Yeah.
Yep. Maybe you're purchasing a vehicle. I feel like this also, like the tariff thing sneaks in there. And you're like, woo, okay.
Yeah.
People financing their fun, or like maybe like a side-by-side, or boats, motorcycles, etc. Those with credit card debt, businesses looking to issue bonds to finance operation or growth.
So borrowers absolutely care about interest rates, but it affects the other side too, right? The savers. Yep. So we have people savers with their CDs, treasuries, bank savings, bonds. And I would add another one, Megan. It affects the investors. Because when you think about all these companies that have stock, many of them have debt. And the amount that they have to pay for that debt greatly affects their profitability and the speed at which they can chase growth. So, podcast listener, I'm betting that one or more of those things that me and Megan just listed, it applies to you. So our goal today is twofold. It's always twofold. We want to help you make better and good decisions. And number two, we want to help provide education that helps you avoid the emotion that many loud voices try to evoke regarding this topic. In other words, we want to help you get smarter. All right, Megan, you've given an answer. You think rates are going to go down, but higher than the next. But do you want to change it, modify it? What's some thoughts here?
Well, maybe before I give my final thoughts, we can talk about some facts and some data first. So, which might then have the answer for you.
Okay. Well, I'm going to give you some not facts or data, but I'm going to give you theory to start. Sound good? It's something called the quantity theory of money. I learned this in banking and finance. I believe it was Business 301 in the Krannert School of Management at Purdue University. Okay. Yeah. And the quantity theory of money says there are three variables. And those three variables are interest rate, inflation rate, and money supply. And there's a correlation. The correlation is that if interest rates go up, less people want to borrow because higher interest rates, so the supply of money will dwindle, and that will cause prices to go down because there will be less demand for products. And when inflation goes down, then interest rates can be reduced because inflation's in control. Well, if you do that, money supply goes up, and eventually over time, if money gets too available, people care less what things cost, and it can cause inflation to happen, and the cycle rinses and repeats. Based upon where we're at right now, where are we at? Well, money supply was greatly increased in 2020-21 when they gave out all this cash, $3.2 trillion in cash. huge amounts
Yep.
of cash,
Mm-hmm.
and a lot of people went and bought a lot of stuff that we would probably call wants, not needs. So prices went way up and inflation went out of control. And so the Federal Reserve started doing what? Cranking rates.
Mm-hmm.
And so where are we at in the cycle? Well, inflation is back lowered. So the next logical step, Megan, according to the theory, you said you wanted facts and data. This is according to the theory, is that the next step in the quantity theory of money is to reduce rates.
It's kind of like what I said.
But you and I, we did some research because we want our podcast crew, we want them to be the most informed person about money. And this is water cooler, blow people's minds information that we found. So let's talk about those three variables. Let's talk about money supply, Megan. Big time macroeconomic money supply. Tell everybody what's going on with money supply in the United States.
The U.S. money supply has increased from around 3 trillion to 19 trillion from 1990 to 2020.
So in 30 years, it's went from 3 trillion to 19 trillion cash available.
Yep. So it's now around 22 trillion, or 22.02 trillion to be more exact, which is far exceeding economic growth.
Yeah. And we looked at this. This is the St. Louis Federal Reserve. So if you ever look at your currency, there's a letter on that, and it tells you which Federal Reserve Bank has issued that note. Okay? So that note is actually backed up with assets because that dollar is a liability to the Federal Reserve, right? Because if you turn it in, you expect value for that, right? So the treasuries back it up, and the things, the assets that they carry pay for those dollars. Kind of crazy to think about. So there's an Atlanta Fed, a New York Fed, a Richmond, Virginia Fed, a Seattle Fed, I believe, a San Francisco Fed. But there's also a St. Louis Fed, and they're responsible for reporting this data on money supply. They also report on inflation, and it spiked to its highest rates in 2022 and early 2023 since the early 1980s. So it's the highest interest rates in 40 plus years. And that's why we're all shocked because, I'm 51. I was a little kiddo. And, we're not making you name your age today, but I would say most of your natural life, if all of it, Megan, it's been very low. So it's kind of shocking. And according to that same St. Louis Fed, the federal funds rate, which is the interest rate, is at its highest rate since the Great Recession of 2007. And I put together a handy dandy chart, and I wanted to show it to everybody. You can take a look at it, but you can just see what has happened to money supply. But you can also see the correlation between the federal funds rate, which is in interest rates, and inflation. Those are those three variables of the quantity theory of money. So, Megan, now we have that theory, and I've given you data, some facts. So let's get your projections of what's going to happen next. Will rates go up? Are they going to stay the same or go down? What's your projection?
I think they're going to go down.
You think they are?
Money supply has increased and inflation is up.
There we go. Excellent.
Based on your chart, I
looked
at it.
Listen, world. Megan Hibbert has spoken. Rates are going down at the next Federal Reserve meeting. All right? So comment in the comments below on that day or after, and let's see if Megan was right.
I didn't say the exact next time. I just say at some point they're going down.
Now, my wiring is for us to not just stay in this theoretical or facts world. We want to offer something practical for our listeners.
That's
right, Megan?
Yep.
We don't want to just talk about data. So it starts with a simple question. The question is, of those three things, the global interest rates, the global supply of money, and the global inflation rate, which of those three can you control? What can you control? Podcast listener, which of those three can you control?
You cannot control any of them, unfortunately.
Because they're macroeconomic variables. You just can't control them, but you can control a few things. So, Megan, we need your help. What are some things that we can control to make sure that inflation or interest rates or the supply of money doesn't have a profound effect on us?
Yep. So we can control our budget.
Yeah.
So having a budget, following a budget.
So let's talk about how simple that is. A simple act of budgeting. being intentional with every dollar you have, it eliminates emotion and it speaks truth to us. And I don't know what it is. Maybe it's because I'm an engineer. That's probably what it is. Maybe it's because I have a math geared mind. But when I get an Excel spreadsheet, Megan, get fired up. Oh, I just love the comfort of numbers because I can be emotional about my money, but that Excel spreadsheet is not emotional. The number is the number. Math is math.
Right.
The math is going to
Yeah.
math. And it speaks truth to me. And I need truth spoken to me. Like when I'm fearful, I can look at it and it's like, you don't need to be fearful. And there's other times when I'm like, oh, this is great. And the budget says, things are not great. You need to get a grip. You're teaching
Yeah.
this for a living and you're being outrageous, right? So the budget
Yeah.
is a truth teller and it's a grace giver. Okay?
Yep.
Yes. Okay. What else?
All right. Personal debt.
What can you control about your personal debt, Megan?
We can work on paying it off
Yes.
and not getting more.
Yes. You can resist swiping.
Yeah.
Right?
Yep.
But it's so hard because, you know, when that car breaks down and you're so frustrated, it's so easy to say, that's it. I'm going to go buy a new one.
Right.
I don't care if this one's paid off. I don't care if I have to have debt. I'm just going to go get a new one. And sometimes the decision is to go get a different one. But maybe, just maybe the emotions of having to deal with a repair are overcoming what is actually a good financial decision. So you can control how much debt you carry. And that's really important. You can control that. So we talk about budget, personal debt. What else can you control?
Yep. So margin, so reserves and monthly margin.
So in our Fully Funded Life program, we talk about the importance of having two types of margin in your life financially. And one of them is reserves. It's cash you have. It's money in the bank. It's money in the safe. It's that cash you can get a hand on right now. But the other type is really important, and that's monthly margin. And that is the difference between what comes in and what actually gets spent every month. And we're not talking about the money you spent into savings and investments. That amount you save and invest every month, that's your operating margin. And if you are operating where all of your income goes out and there is no savings and no investing, you have no monthly margin, inflation goes up, you're immediately in the deficit. You add a debt payment to it, you're immediately in the deficit side. And so really make sure that you're in a position that every month you're holding yourself accountable to save money, to have that monthly margin. And Megan, I always ask this question, if you have the choice of having reserves margin, money in the bank, or having monthly margin, money that you can put aside every month, which would you choose? Which would you choose of those two?
I don't know.
You have to choose, Megan.
Maybe reserves, because I can cut things out every month.
Oh, because you're saying I can take action.
Yeah.
So that's really good. So my natural reaction is to say, I've already cut everything out. So I would rather have monthly margin because that allows me to build reserves margin. But I like your approach too. So, hey, this is a good point where we'd love to hear from our listeners. Which would you prefer? It's a good question. And then there's one other thing you can control that we wanted to share, and what's that?
Yep. So investments, assets.
Yeah. So think about investments. Investments in real estate, for example. Having real estate, it really inflation proofs you, right? Because if prices go up, the price of your real estate goes up. Many people are like, I can't believe how much my house is worth now. Well, it's actually about worth what that's equivalent of money, like the $200,000 house that's now $400,000 house. That $400,000 today can buy what $200,000 could buy back then. It is inflation proofed. So it's really, your dollar has been eroded in value. Okay. But having the house has helped you inflation proof your life. And many people, they don't really comprehend that when they have mutual funds in a retirement account, that has stock in it, and stocks are part ownership of these businesses. So as the dollar is devalued, well, hey, the company, quote, dollar value goes up. So if you own Amazon stock, which you probably do in your mutual fund. You have Google stock, you have Meta stock, which is Facebook. Hey, it's inflation proofed, and you've probably beat inflation. You've definitely beat inflation if you had those investments. And so you can control that. You can control investing in that. And so I wanted to bring this episode to you today because this is a hot topic about interest rates. And we wanted you to understand the theory, quantity theory of money. And then we wanted you to understand that you can't control those three variables individually, but you can take action in your own personal finances to accommodate them and be in position to pounce on opportunities like a puma. So Megan, I have a question. Do you feel smarter now that we've talked about it?
So much smarter.
I do. I feel like you and I should be awarded honorary doctorates in macroeconomics.
There you go.
Dun,
That'd be
dun,
great.
dun, 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 dun. Do you hear it? I hear the music. You've got a degree behind you. There should be another one.
Yeah,
Yes,
I agree.
From Podcast University. So, one other question. Megan, are you going to be discussing the quantity theory of money with your husband, Jordan, and your baby boys tonight at dinner?
Oh, yeah. Can't wait. They're going to be riveted.
Well, I do encourage you to have the conversation at water coolers, y'all. And so excited to be able to talk about kind of a geeky, nerdy topic, but one that has a profound impact on all of us. So the next time somebody says, yeah, I heard J. Powell didn't lower rates, you can say, well, actually, I believe rates are going to go down. Why? Because of the quantity theory of money. And your friends will say, you are so smart.
Wow.
Well, thank you all for joining us for the Monday Money Tip. Hey, we encourage you to check out fullyfunded.life. It is a great way to take your financial education to another level, receive financial coaching, and progress along your journey to live your fully funded life. Have a great Monday, everybody, and get fired up.